All right, we're recording, and we're going to just talk through this AI trade that we started yesterday, and we've got pieces, basically. Sometimes these things are structured on the same day. Sometimes that you're willing to take a little risk, and it paid off for us today. And so the combination move yesterday was to enter shares at 41. 97 on average, 5,000 shares on average. We sold naked puts out to September 15th. So this September 15th, naked puts for $7.05. And then today, what we did is we waited. That was the only two moves that were made yesterday. If you're going to hold a stock and look for an opportunity that looks like the charts are setting up to give you, then I'll wait for the covered call, and I'll wait to add the next layer of the trade. And so the next two layers of this trade became covered calls on 25% of these 5,000 shares. Not exact, because 100 lots, blah, 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 but close to 25% of the shares. Covered calls entered at $4. They closed above $4, so they're actually worth, if it keeps going up, those will start working against me. I don't care. If you want to call out, 1,250 shares at $45 and pay me $4, then from my $41.90 entry, let's say 42 to keep the math clean, then I would have made the $3 on the shares up to 45, okay, plus the $4 call premium. So I will have a $7 a share on 1,250 shares that was locked in. If I get called out, that's fine. If the stock comes and it's below $45, now what I've done is I've gotten $4, which would take me from the gains made today, right, back down to 40, let's say. I would have made most of that up in this covered call, right? So my holding price on 1,250 shares would have been reduced by $4. And then you could divide that by 5,000 and get what the total hold price would be on a go-forward basis. On the puts, two things happened. So obviously the puts dropped down to 590 at the time that we were talking about it earlier. So they were up over $1 from where we had entered those naked puts. And then the next step is to determine if I want to put a collar, something that would protect my downside. And I was batting back and forth between doing something lower cost before earnings, but the premiums were such that I ended up just beginning, and I didn't take anything close to a full position simply because of this momentum and closing near the high of the day. I just barely started taking a put position for the 35, September 2nd. The September 2nd earnings are August 30th. And so what I'm looking for is to give myself complete protection on all of my shares held through that earnings period. And then that allows me to make determination. And by the way, this encompasses shares and puts. So if I have 10,000 shares of puts represented with 100 of those, then I will have that covered in this put. So that, again, I would be making entry price at $42.50 minus $7.05 is 45, I believe we calculated it to. And so anything below 34, 35 is profit. That may be wrong on that. Is it 35? It's 35, 30, 35. Okay. So with my puts here, I'm not risking much of a downside. And if it did collapse after earnings and I've got to the 15th, obviously I would prefer the stock to find some type of a, much like what Target does and what most stocks do, is they'll find their base support level. And when that happens and you see that happen, then the puts that you had bought for September 2nd are going to be worth a whole lot that next morning. But you would need to sell them immediately because of the crush that happens to premium after earnings. But because it would be so low, if it did crush down, the stock was collapsing, then these are going to be way in the money, or way profitable at that point. So they'd probably be worth, even after earnings, they would be worth probably $5 to $6, something of that nature. And so I would probably hold those through expiration, depending on what's happening with the stock. Obviously, if the stock was below $35, a decision would have to be made in terms of do I just exit with the $35 put and basically assign those to someone. Obviously, this is disaster that I'm looking at. I don't think that's going to happen, but it's just basically protecting all directional attitudes of that. So what I wanted to do is I wanted to beat earnings or race upwards even into earnings because I still have 50 shares that are sitting there, plus these puts. If these puts drop down into earnings and they were somewhere around $3 because the stock just kept on going higher, well, then I would just close those puts out. I would just take that gain on those puts, and that would be that aspect of the trade. All I would be dealing with then is my covered calls, which, the stock would get called out. And then I have 3,750 shares that I would need to look at doing some type of protection. But, if the stock's at 50, I bought it at 41.97, then I don't mind using $2, $3 of those profits in order to protect downside after earnings further out. So I would go further out, as far out as I could. That way, if the markets hit into some type of a real correction, then I would be somewhere with my puts. If it's at 50, my puts would be coming in somewhere above what my entry price is. And I'm sure they wouldn't be more than, $2, $3. So I would just use some of the gains from these naked puts into earnings if they had pushed up and exit. And then I could be using those gains versus the gains on the shares to protect the gains on the shares. So it's a very sophisticated approach to this. It's one that I do quite often. I've always preached to the forum before we started this company. I've always preached, I do not go into earnings naked on a stock, because I experienced early on losing a $100 stock down to 50. Or a $200 stock down to 130. I refuse to expose my portfolio to those massive movements unless it's to my benefit. And so this is one type of strategy. Now, obviously the AI we just entered. If I had been in a stock from 30 and it's risen to 50 and earnings is right around the corner and on trend, I'm $20 into the stock to the good. Well, I will then utilize either a covered call on 25% that I would normally want to, take at that point anyway. And I would enter a covered call using the premium into earnings. And then I would use that premium to buy a put across the entire position. But I always go 100% protection on the downside. And if I can use a portion of 25% covered call to do it, awesome. If I also have to dig in to my $20 in gains and use $2 of it, $3 of it, I'll do it. Why are people so short-sighted not to want to spend their gains in order to protect the house. So this is the lesson. This is this. We'll track this as we go, and let's see how this turns out at the conclusion of once these things go. But a very sophisticated trade, and that's our number one. Okay, number one. And tomorrow what we'll do is we'll talk about bear market, descending market strategy. That's an advanced tactic strategy that, I mean, y'all saw it on Twitter. I was telling everyone on Twitter what to do. And so we'll share. Meta was one that we entered. And that was like a 10,000 shares across multiple accounts. 10,000 here, 10,000 there. There's multiple accounts, but we used a strategy and the stock literally kept going down against us. And we'll look at that in terms of how that math works out, the decisions that had to be made, and have that as a strategy. These are two huge strategies that eventually I want everyone understanding fully, and I want everyone employing to your benefit, because you can go larger and larger on your shareholdings with these type strategies, can't you? Right? You can go so much larger in your holdings if you have no empirical downside risk. Sometimes the risk might be this is going to break even at worst, and I'll figure it that way, and that's fine. A break-even trade with such huge upside potential, that's okay. If I'm leveraging large volume doing it, that's okay. So we'll discuss that some more as we move along. We'll finish today just with, so since this is recorded, talking about the SPX and SPY. Yesterday, what we did, just in case there's people in here that weren't in here yesterday or at the beginning, we talked about yesterday the fact that the macro markets have this wide outside bar formation. All of the action that's happened has been inside this. And until that breaks one direction or the other, we don't want to be massive in our positions unless you use strategies. Then you can be a little bit more flexible with it. If you use these multifaceted strategies, then you could be more aggressive right now. But otherwise, what we're doing is we're waiting for it to break up or out. The sense yesterday was because of the fact that we had moved across right here, the level here, that would be a natural resistance level. That's the first thing that came into my head. The fact that we had not tested below, after the inside bar, we had not tested below the 50% level. And so the lean, along with looking at 4-hour, 15-minute volumes on each of those, my determination was today we would have a down day. And we even picked the number, 455. 56 was our low point for the day, was our target, and we did exactly that. Okay, we came exactly within pennies, 53 and low 49. So within pennies of our target. I don't know what this one was. That was 70. So within pennies of where we looked at in terms of our initial downside, this is where it was. Now that's Model T on the dailies. So if I take this outside bar and I take the high and low, divide it by 2, it's right in this area. And so what that means, fortunately or unfortunately, as it were, okay, what that means is we haven't even crossed over to test any downside of this outside bar. We have good earnings from AMD. We had some good earnings from some others. This could buoy the market and rip upward tomorrow. We have some very high stocks coming up in the next few days. I didn't even look at CAT. What did Caterpillar do after earnings? Okay, it's plus 23, so they blew out earnings. So again, the Dow is going to probably benefit from that. Or did they report? Did they not report yet? Oh, they reported before the bell, and so they're up 23. dollars today. So a very strong chart on there. All of those things could buoy the market, and we don't see the downside. But if we do lose this Model T that we hit today, and we start fading below it, we could watch for a reclaim, like a wick through and back, and that starts something. Or we could see a fade into that 453.50 area, would be where my next level down would be, is at 453.50. So just like we marked today, 455.56 on your alerts, you would put 453.90 so that your eyes would be on it, watching. And if you see an acceleration move into that, one thing I didn't do talking to all of this is, did we into these lows of the day? Oh yeah, I would say we did. So we a big acceleration move into these lows. Yeah, big acceleration move into these reversal, liquidity grab, wick reversal there. Same here, just this major acceleration down. This is what we're typically going to see when those are hit. So overall, though, I mean, when we look, I want to keep our bearings straight. When we look at the S&P and/or SPY overall, we have got a beautiful upside channel that's formed. Okay. And until that's a bad draw. But until that would be violated, and that outside bar would probably start violating that. Until that's violated, you got a tighter trend here, and that's because it's been working the upper end of that channel all the way through. So if it came down to here, then that would be a first indication of a potential larger correction. But as for right now, this is just showing that there is still a lot of buying interest going on. It can't even break below Model T on this, the halfway point. So let's keep our macro focus in the proper perspective. Markets look powerful. When you break out of this downtrend cycle, and when it reversed out, if you had drawn your trend lines, and we talked about it on Twitter. But you have these down lines, and then you break out above, and this here, and then you're watching this pattern come right here. You've got a change of structure. You are no longer in a hard down channel. You couldn't even make Model T off of this. That would have been somewhere in this area. That showed buying interest, and then it runs away. Okay, so certainly by here, people should have recognized what we had, and then this retest here of this structure, okay, I should have been a little bit lower into this right here, this candle. That would have been right here to retest. That's absolutely expected and fine. And then off we go. And we should have been bull. I mean, everyone should be bull buying until this would change the structure. So we've got a complete bullish scenario. And this was pretty long. So why wouldn't you expect a longer bull trend? Now, I mean, it surprised me. I thought 4,500. I tell you where my thought process was when I said 4,500 when we were down here was my target, is because if you're going to have a bear continuation to the downside, that would have been max Q, right? That would have been, you can't go above 45.25 and not reverse and end this. If you're going to be a bear market, right? It would have been a wonderful move up into a channel. So, this 4,500 level here would have been the end of that. It would have been like a 50% reclaim push above, just to get everyone excited right in here. That level is where we were, and it just blew right through it. And so now we could be looking at a bull market phase that goes all the way up and tests the all-time highs. So this right here is our key. And I mean, look at it. It's just like a huge enchilada sitting there waiting to tell us direction. We've got our alerts set on it. It's as clear as a picture as you're ever going to get in the market indicators on the macro scale. As clear as it can get. And so we will be looking at those because it opens up the door to really trade much larger, much more confidently and harder. So in the meantime, we'll look for opportunities, and we'll be trading, obviously, and we've done pretty well through this period. So we'll continue to look to do that, and then we'll go from there. Okay. That is it. Have a good day.